Hello and welcome to another episode of the Investor Financing Podcast. I'm your host, Beau. We have a great show today. We're going to talk about boots on the ground, multifamily investing, actually transacting locally as an asset manager. Please welcome Sandhya to the show. She's an LP, a KP, a GP in over 4,000 units. If you don't know what the LP is, that's a limited partner. KP is a key principal. That's usually somebody that comes in to sign for a balance sheet, meaning that they use their net worth as a key principal in the transaction, and then they're as a general partner. So there's all these different pieces within a multifamily real estate syndication, and our guest today has been involved in every aspect, including being an asset manager. And what I like about today's show, we're going to talk about being local and building community and building social impact through your local connections. Thanks for joining us. Welcome to the show.
Thank you so much for having me here. I'm very excited to be on this show and explain what we do.
Yeah, that's great. So you have a master's degree in a business degree. Your background's electrical engineering, a very professional background. Obviously, you're a numbers person. So we were talking before we went live on the show that certain people, and it seems to be engineers, do really well in the multifamily syndication world because they can dive into the weeds, they can look at numbers, they can look at spreadsheets, they can analyze quickly, and he makes it really efficient. So why don't you walk us back just to like when you like I read on your website, I like this part. It said that you moved into commercial real estate because you saw the ability that you can uniquely force appreciation and the ability for all the tax advantages, right? Like once you saw that, you're like, wait, there's a better way from, there's a corporate world. I do great. I make money, but I'm getting taxed at the highest level possible. And then you found multifamily. Okay. So when was this in your career? Was this like 5 years ago? Was this 6 years ago? When did you really dive into the multifamily business?
I started about 3 years ago, actually, in the multifamily business. I realized very quickly from a lot of friends who were doing single family that the margins just weren't there unless you actually went in and did a fix and flip kind of thing where you spent all day working on a property. And I did not have a handy person kind of background growing up, fixing up the house. So that's not something I really wanted to do full time. And the margins weren't enough, like they were only in the few $100 range for me to do a single family rental versus with multifamily, you can scale up. So you buy 100 doors and a couple of tenants don't pay the rent. You don't lose 100% of your rent like in a single family. And you underwrite your deals already with that economic vacancy included in your numbers. So all of the analysis just pointed directly to you've got to scale to make money. And in multifamily, and to impact these communities as well, one at a time.
It's amazing that being part of 4,000 doors in just 3 years, that's like, do you wake up now and go, wow, like that's pretty awesome that in 3 years, granted, some of them are limited partners where you're more of a passive investor, but the projects that, overall, that's overwhelming to think that you can, in 3 years time, you can do something like that. But how did you set out first off? Was your initial investment in it as an LP, or did you jump? And so you found an operator that you believed in, and you invested $50, $100, $200,000, whatever the minimum, whatever you invested, and that performed well. And then walk me through like the evolution of your business, how you went from LP to a GP or KP, and what did that look like?
Yes. So when I realized very quickly that single family wasn't going to be the right for me, I joined a mentoring program that helped me scale and collapse timeframes. So by joining a mentoring program, I got the education, which is the most important thing for any new venture. And I also got the opportunity to meet a lot of different people, like-minded with the same goals, but we also underwrite deals the same way. And that helped a lot as far as finding partners. And so finding people who I could trust with my money, my hard-earned money. So I had a lot of retirement money from my corporate career. So I used that first to invest as a limited partner. So that was money I wasn't counting on in the near future, and I could wait for it for 5, 10 years, etc. And that made it less stressful to invest my money, hard-earned money, with somebody else. So being a limited partner, let's say it's 50,000 at a time is your investment. you establish a connection with the general partner as well. So it's an easy way to learn the business without taking on all the risk yourself. Because as a general partner, you have to make all the decisions, you have to sign on loans, etc. Versus as a limited partner, it's just like you investing in a stock, like Amazon stock. The CEO of Amazon is making all the decisions for you. You just invest your money in the hope that it appreciates in value. So you're not taking on the bigger risks associated with running a property. So that's an easy entryway if you've got the financials. So like me, if you've already done some years in the corporate world, you probably have some money saved up that is available for you to invest. And that's how I started. And then once I learned the business, I made sure I only invested in deals in the Dallas area, which is where I live, so that I could go visit these properties and learn the asset management side of it. And then I found partners with experience, but they were located out of state. So I could offer my local experience. I could tell them about, the safe neighborhoods, the good areas to invest in. And then while they made all their decisions, I could run and execute the things for them. And so that's how I found my first deal. And then after that, once I got the confidence, I started being the lead sponsor myself, talking to brokers, speaking the same lingo, convincing them that I know what I'm doing, so I get awarded the deals. And of course, the underwriting piece is a very important part of it, knowing your neighborhoods, markets, subdivisions, where it's safe to invest, et cetera, is a very big piece of it. And then once you have that confidence and knowledge, then investors start to trust you. It really helps if they can drive and see the place as well. This is a real solid apartment right here that you can see, touch, and feel, so to speak. And that made a big difference. And one thing to point out in 4,000 doors, it's a very, very tiny percentage of it that I own, right? It's not like I'm the owner of 4,000 doors. No, I don't own a $20 million apartment. I own it with the bank paying 80% of the loan for us. The bank really owns our assets because we take loans for 75 to 80% of the purchase price. And then the rest of it is from a syndication model where we all pool our money together, investors 50K at a time, to come up with 5, 6, 7, $10 million. That becomes the down payment. Just like if you bought a single family home, you're putting down 20 or 30% of the purchase price. It's the same concept, except at a larger scale.
Yeah, no, that makes sense. So are you still working your corporate job, or now are you full-time real estate with?
I'm full-time into real estate. I was trading stocks quite a bit, actively, even after I quit my corporate job, but now I'm fully into real estate. So this is what I love to do, and it really helps to be local to all these properties.
So Texas in particular has just absolutely boomed. A lot of states have boomed, a lot of areas all over. I mean, I've been talking to other syndicators, and they're just getting, within a year, their values have gone up with kind of, it's really not so much the operator as that the market, right? Like the market's done so well. Yep. So investors are kind of been spoiled over the last 5 or 6 years, where it's hard to think that it's sustainable, like this much kind of forced appreciation. So what's your outlook kind of going forward? I think, are you being a lot more conservative, or are you still pretty bullish that there's such a shortage, that there's such a demand, that there's plenty of underperforming buildings you can still buy?
So I'm very bullish on the Texas market, and especially Dallas in particular, that I'm familiar with. But even back in the day, like in 2019, when I was underwriting deals, we always underwrite them with what I call a higher exit cap, which means you're assuming a much more, shall we say, down market when you're ready to sell the property in 5 years. So when I purchased it at, let's say, a 5 cap. I underwrote it for a 7 cap as an exit. So there's always plenty of cushion in my underwriting to consider worse economy at the time of sale. So even today, we would do exactly the same thing, except we would underwrite it for a higher interest rate. I mean, 2019, we were getting 5% as our interest rate, and we were super happy, 5 and 5.5. And I think recently in 2020, 2021, maybe people got spoiled with getting 3% kind of interest rates, or even sub 3%. So now people are like, oh my gosh, the interest rates are going up. I don't know if I can afford to buy. Okay, well, just underwrite it for 5.5% and 6%. I mean, if you remember back in the day, 80s, 90s, etc., 5 or 6% was considered a great interest rate. So that's number one. The second thing is cap rates. Yeah, I mean, underwrite your deals for a cap rate that's at least 100 basis points higher than what you're purchasing it for. And see if the deal still works, see if it's still acceptable returns for your investors. I mean, it's all about your investors, right? I mean, there's investors with pension funds and so many other kind of bond funds, et cetera, where they barely get 5 or 6% a year. And if you look at your, let's say, a portfolio managed for you by a wealth strategist, how much money have you really made on the stock market year over year? So if you compare all that to the multifamily space, I think there's still plenty of opportunity in the Sunbelt states. And of course, I'm going to talk a lot more about Dallas-Fort Worth, which I'm very familiar with. But yeah, I would definitely invest even in Phoenix, Atlanta, after studying the markets and neighborhoods, of course.
Yeah, the Texas, isn't Dallas, Fort Worth, and what do they say, is part of the Texas Triangle with, and I was reading all these statistics. It's overwhelming about the Fortune 500 companies. I mean, there's just so many. You're right. I mean, after reading that, I was like, wow, now I understand like what's going on in Texas. 'Cause I'm here in Las Vegas, but a little bit different. I mean, we're experiencing a boom too, but we don't have nearly the infrastructure with job creation that I think Texas does. So you're getting a lot of people relocating from California and the West Coast, a lot of tech companies going there.
Yeah.
So pretty much all you're looking at asset class wise is multifamily. You have no desire to underwrite anything at this point other than multifamily?
Not unless something happens to the multifamily boom. I mean, it's sort of like, become a specialist in one thing and do that really, really well and make that, a rinse and repeat kind of process, like almost like an assembly line level of efficiency. You know this one thing well, and become a local expert and do it well. So unless it, for any reason, it doesn't go, I went through COVID, right? 2020, we went through COVID, March of 2020. Nobody could predict that this was going to happen. And the nation shut down and people were still paying rent. I mean, I had less than 5% of tenants across my properties not paying rent, and we helped them apply for rental relief. So, I mean, we withstood a really bad pandemic and did so well. And I had a property I purchased in August of 2019 that we sold in November 2021. And we made like a 3x return to investors. That means somebody put 100K in it, they end up making 300K at the end of it, right? How do you do that on a property that was predominantly held through the pandemic? So yes, cap rate compression probably was half of it, but the other half of it was just forced appreciation. I mean, you add amenities and things that tenants are willing to pay for. I mean, it's a choice for a resident to live at your apartment or go somewhere else, right? So obviously, you have to do something right for them to be willing to pay maybe $50 more for that same apartment. You have to do something there to make it appeal to them.
Are you vertically integrated or are you just always outsourced? Because obviously the advantage of what you're doing is you're driving properties, you're shaking hands, you're meeting tenants, you're networking with you have a meetup. When you started 3 years ago and you went through this mastermind, you joined this mastermind group and you basically built a team of potential investor partners, both passively and co-GPs. But what did you do locally? I mean, I guess three-pronged question is, are you managing your properties yourself? Are you outsourcing that to third party? And then let's talk about, how you were so quickly able to basically build a huge investor list and service them through your meetups and your networking.
So the first part is, no, I'm not vertically integrated. I've always looked into it, but we found great property management companies locally. And I actually have 3 different property management companies with all my properties because I look for one who has a property that they run very close to my subject property so that it's not just within a 20-mile radius. I literally look for somebody on the same street running another property nearby so that if there's an emergency at my property, I lose a maintenance guy, there so many of them have in the past year or so gotten higher wages and offers, and so they just leave. So I like the property management company to be as close as possible to my property and be able to help in times of need. So that's one, that's very important. They have to have that local submarket knowledge, because within this zip code, with this demographic, this type of property, have they been successful? And so I look for that. I know that in the future, that's always a subject that a lot of people have talked about, but right now, this has served me very well. Having that disconnect, so to speak, and being able to hire a property management company. In terms of investor database, yes, you keep serving your investors by showing them your properties. You find them through meetups, you find them within your groups. But the biggest thing is, are you keeping their interest in mind, right? Is this the right investment for them? If this is their last $50,000, I don't want them to put it in here. And if they need the liquidity, if they need to cash the money out within 6 months or a year, then this is not the right investment for them. And you just stay authentic and help investors achieve their goals, then it's okay. You build that trust with them and you deliver, and you keep building on that. And then that's when you get the referrals. Just like with any business, you go to a restaurant, the food tastes great, you're going to tell 5 friends about it. It's the same thing. The first deal when I tripled people's money, well, they couldn't stop talking about it. So of course I got a lot of referrals after that. So that's kind of, it's a slow process. It's not overnight success. You got to work hard at it. And, if you do the right thing by your investors and your tenants or residents of your communities, those are your 2 customers, then the rest will happen automatically. You just keep those 2 in mind with every action you take, and the rest will follow.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau Eckstein here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day. Knowing what you know now in this business, what would you have done differently?
I would have bought a lot more properties sooner. That's the biggest thing, is why didn't I buy half a dozen more properties? And I think I was being slow and cautious and very hands-on and afraid to take on more and get overloaded to where I couldn't pay attention to the properties. But I really think I should have accelerated sooner.
So it sounded like, you were quite successful in your corporate business, and then you had your side hustle and you were trading stocks, probably making good. So it sounded like you were on the track to being pretty financially free, whether you got into multifamily or not. But what, in this last 3 years, how much has multifamily turbocharged your retirement? Not like just in general. Now you don't have to get into the specifics, but just so people get the understanding of like the appreciation side of it, the equity side of it, the write-off side of it. I mean, people that aren't into commercial real estate might not understand they might not know about cost segregation, about, hey, you might have made $2 million and you would have a 40% or 45% tax consequence, but through cost segregation and things like that, you can offset almost all of your taxable consequences. So like, how do you portray that to your investors? A lot of your investors are probably successful corporate people, and you got to like show them like, hey, there's a better way through these different strategies.
So the biggest one is to look at the risk, right? So what is your risk adjusted returns? Like you look at a Sharpe ratio in stocks. So you look at it and say, look at the volatility of the stock market when in March 2020, COVID struck and there was that one day when everything crashed, right? But then you look at the value of your real estate portfolio, it's not really affected as much. So you say that it makes sense for you if you have $1 million in your retirement account, or you have all this money that you've left with a wealth strategist, why not start dabbling a little bit at a time into real estate, seeing how that goes? And then you can decide for yourself if, 6 months, a year from today. I mean, obviously the ones who invested in my deal that I just tripled their money, they were like, okay, no stock has done this for me unless I put all my money into something like Tesla before, went crazy. So with most investors, the way to do it is to just give them the 2 comparisons and just watch how the portfolio goes. from stock market versus real estate in parallel. Let's put 50K here, 50K there, and boom, let's see what happens in a year's time. And I forgot what the other part of your question was.
So did I. But I was getting at, like, over the last 3 years, I was
Tax
just
advantages.
Yeah, well, I was just proving a point. Like, you worked X amount of years in your corporate world, and I bet over the last 3 years you probably like quadrupled what you had put together because of multifamily. Like, you can supercharge your retirement account, and let's face it, $1 million sounds like a lot of money, but it really isn't a lot of money for retirement, right? With inflation going up, like, people need to plan, and they need to make better returns than 3 or 4 or 5%. They need to make, because you got to try to double your money every 5 or 6 years. And with multifamily, you just talked about a deal that you had for less than 2 years that you tripled the equity. So there's like, you can supercharge your retirement account. And even if you're in the corporate world, it might be advantageous to start in this journey by investing with an experienced operator as an LP, a limited partner. So, like, when somebody reaches out to you that they're interested in investing, you usually probably meet with them over Zoom or on the phone, right? Because you're probably getting a lot of people now that, like, are in the corporate world. They might have a little bit of money, and now they're saying, "Wait, yeah, I've worked hard all my life, but I only have X. I have $1.2 million total in my retirement," which sounds like to most people would be a lot of money, but really, for them to live their lifestyle, they're going to have to. They're going to have to get $5-10 million net worth is really where you need to go to be able to retire. I mean, I look at that now, like, I'm 44 years old. What will I need at 60, right? What will I need at 65? And my biggest fear is being that person that has to work in their 70s. And I'll work in my 70s if I want to, but I mean, I don't want to have to, right? Like, there's a big difference. And so I think it's kind of a scary situation for all these people that are approaching their retirement years. They worked their whole life and they have a decent amount of money compared to the average American, but really they're not in a really good position. So this is a time they really need to start thinking about, diversifying their holdings. And that's what you do. You educate people.
So, like, 90% of millionaires are through real estate, right? Real estate really was what appreciates and builds generational wealth. So how do you put how do you have a piece of real estate without doing all the landlord kind of work, right? The tenants, toilets, trash, and termites. Like, I want to totally avoid that. So that's why I have a property management company, and I can only afford them because I have the economies of scale from 100 plus doors. But doubling your money every 5 years is very reasonable to do if you invest in the right assets in the right markets with operators whose focus is managing these assets, right? Not people with full-time jobs who kind of happen to have maybe the occasional bi-weekly call with a property management company, and they're sitting in California and the property's out in, the North Carolina or Texas or something, right? That's very different from people who are full-time, dedicated, local to the property, and therefore are just producing results that are, more asymmetric compared to the typical results you get from closing your eyes and throwing money at somewhere.
In a deal that you invested strictly as an LP, out of the deals you invested in as an LP, what was the biggest learning lesson that you might have invested with a sponsor and you weren't happy the way they ran something? You don't have to get into details, specifics, but just kind of high level, just some kind of tips and tricks of what to look for as a limited partner when you're trying to find a good operator to invest in, things that you saw that you're like, hey, I don't really like this, how they're doing this.
So one of the things I saw was with an operator who was local to the area and ran a construction company, was that he was more interested in getting construction projects by the millions awarded to his company. And he also had a large acquisition fee up front, which meant that regardless of how the deal did, it didn't really affect him financially, right? Versus an operator with whom they don't take an acquisition fee at all, or it's a very small amount, and they don't have any personal interest in, they're not making money because, hey, I own the property management company, I own the construction company, I'm going to make money off of this deal, whether or not the deal performs well. So that's the caveat to being all vertically integrated, because the operator is going to make money regardless of how the property performs. So the biggest thing to look for is is their focus on the asset management, which is after the honeymoon is over, after the deal is closed, who's going to be watching it day to day? And is that person dedicated to that? Or are they just going after the next acquisition? Oh, I want to get 5,000 doors by this date or 10,000 doors by this date, versus, hey, I'm at my property every week. I keep tabs on property management. I address delinquency. So in 2020, what should be your focus? Delinquency, right? Versus not spending more CapEx dollars on new construction projects. So that was my worst performing deal. And since then, of course, I've made it a point not to invest with people who do not have a focus on asset management. And the biggest thing I can tell you is I've got 23 deals where I'm a limited partner, right? That's a lot of deals. And I have developed a checklist to vet a sponsorship team as well as a deal. So if any of your listeners are interested, they can visit my website and put their contact info and I can send it to them. And it does not add them to my database. So no worries. This is not spam.
That's perfect. No, I like that. I think that's a valuable point is on syndications when if you're a passive investor listening to this or you want to be a passive investor, you got to look at like what are the fees that the syndicator is charging up front. If they're charging a heavy acquisition fee, they're really motivated. They're become kind of deal junkies just for that fee, right? Because they might be making a substantial amount of money up front, and then hey, they made their money on the deal already. And then if they're vertically integrated, saying that maybe doing the construction, they're making a 20% profit margin on all the construction. So really, that may not be in your best interest. And I do think that there's probably going to be some, as the market kind of levels out a little bit, right? There's going to be, because I interview a lot of people, there's going to be some stuff that hits the fan because not everyone's going to hit home run deals and think, problems happen and so forth. So it'll be interesting to watch as this market kind of normalizes and it isn't like as crazy as it is right now. That will kind of separate the people that are actually really paying attention, because you got to really be paying attention to your asset management, to your property managers, even though there's things to do. You got to check the statements, and it's not like, I think people make it look too easy, I think sometimes from the outside, and they're always posting their wins, but also like it'd be good to hear from operators, like what struggles are you having? What's the honest, going on, and I've heard horror stories where, there's been 2 or 3 capital calls, right? Because they didn't estimate their repairs appropriately and so forth.
That's right.
These are things so your checklist is very valuable. So I'm going to get that for myself too, just because it's good to like, what are the questions I should be looking for in different syndication options? Because I think ultimately, like if I look at my life, if I could be in the position just to invest as a limited partner with good operators, to me, that would be amazing, because that's the most passive you can get. And I always say that if you want to be that, like, yes, you're not getting the highest return versus somebody who's actually operating the deal, but for your time, you're getting the best return. You're getting the best return.
And so one of the biggest things I ask is, okay, someone is bragging that they have 5,000 doors, 10,000 doors. Well, give me a list of all your properties. The ones who've gone a full cycle, the ones you're still operating. Now give me a name of a passive investor in each of those properties. So I can talk to the passive investor about how the property really performed, versus you're only going to brag about the best stuff, or you're only going to refer me to your best friend who's going to sing your praises. So how did each deal perform from the view of a passive investor? That's very important. Just like before you hire a contractor, you're going to call for references, right? It's the same thing. You're going to put $50K into a deal, get some references for every deal. How does this add up to 10,000 doors that you own? Okay, show me all the performance of each deal. Initial projections versus how you're doing today. Did you actually make distributions as you said you would?
Yeah, that's so important. And I think even when people are buying franchises, right? They call it validating. You actually talk to other people that have this franchise.
Yep.
What's your experience with? That's where you're going to get the most nuggets from, because you're only going to, when you go to somebody's website, you're only going to see the great, the perfect, like this is what we've achieved, but all in all. So that's a very good point. Like, really get in. There's so many people, surprisingly that don't do any due diligence and just will hear about something and put a bunch of money in it, and then they're surprised when the outcome isn't what they expected. So I think that's a huge important part, and that's why, like for me, like if I was to be a GP in a larger multifamily deal, I've done a lot of fix and flip and small rental properties, and that's easy for me. But like these bigger properties where I feel my strength is in underwriting a deal. I'm not a spreadsheet person. Although I do loans for a living, I just don't enjoy that. So you're gonna want the right team members too. You need, just it's fun when you buy the deal, but then like the next 2 or 3, 4 years of the asset management and the meetings and making sure things run, and property managers or handyman quitting, and you have to find replacement work. That's where it really kind of, you got to put in the work, especially as the market starts changing. So. Anyways, multifamilyforyou.com. The 4 is not spelled out, just the number 4, multifamilyforyou.com. Get the checklist. And any closing marks on what you think kind of drove you to being so successful so short? I mean, granted, I know you have your 20-year career but what do you think was the biggest factor that helped you grow this business?
I think project management skills from my corporate world. So I can look at things at a very high level and immediately know where I need to zoom in, what we call the critical path in project management, and focus on that. So I can look at it as a high level vision, like a helicopter view, but I can also dive into the details, being the engineer that I am, and that helps. And then persistence. And never give up. There's always somebody who solved the problem that's ahead of you. So find them. It's who, not how, like the book says. You find people to solve your problems, because overnight you're not going to come up with all the answers. And find team members with complementary strengths to you. Don't find people just like you. You want people who think completely different from you. So you get all different viewpoints. And as a team, you're a complete fit for what your residents and your investors need. I would say those would be the 2 or 3 most critical things. And then my website is multifamily4you.com.
Thank you so much. This was awesome. I really appreciate the insight. And I just listened to the Who Not How book, and then it was like, that was actually, I said this year that was the number 1 influential book for me this year. And then I'm also just finished Never Eat Alone, which is really about networking and building a network. And these are, both of those books are really geared for any business, but if you can specify it in the real estate business, and really those books can really, really help you, because that's all you need. You need the right people that, and you need to learn how to delegate. And then, and that's what Who Not How really says. It's like, I don't necessarily need to underwrite the deal, because I can get you on my team potentially, right? Like, and I know you're going to be super analytical, and you're going to get me all the information I can. And that's what I would do, right? If I'm going to syndicate a deal, is I'm going to get somebody like you on my team that's got the strength that I don't. And that was great advice. So anyways, hope you guys enjoyed this episode. This was really good. And I love diving in the weeds about all this real estate investing and multifamily. And there's so much opportunity with real estate, whether, I know a lot of people are concerned out there about inflation, but historically, real estate's always been and always will be the best investment you can make. It's just that you got to weather the storm and underwrite and stress test your deals for, things that might happen. Occupancy's dropping and people losing jobs and things. And as long as you stress test, you should be fine, and you have appropriate reserves in your account, you're going to do it just fine. So anyways, see you on the next episode, everyone. Thanks so much. And thank you.
Thank you so much. This was great.